where gold tends to go up is when money supply is increasing and inflation's building, but the central bank hasn't really acted yet, or they've tried to act and they've not really been able to contain it. Those are the scenarios where gold tends to do well in inflationary times. Gold can also do well in disinflationary times if you have a rapid fall in real rates. There's a number of different contexts where gold does well, but the really big picture view is that gold and similar assets tend to do well in decades where neither stocks or bonds do, and that's where gold tends to be a useful diversifier.
So, Lynn, today's topic is gold, and let's just get right into it. Gold has been hitting all-time highs, one after the other here recently. So let's just start with that. What has been the reason for the recent rally?
Well, any sort of price movement has multiple reasons. I mean, at the end of the day, there's more buyers than sellers. So what we can do is we can kind of determine where that buying is coming from. It's not coming from ETFs, for example, in the Western world. Their tonnage is actually down from all-time highs, and it's not doing very good on that front. Instead, a lot of the buying is coming from foreign central banks, as well as from foreign private sector, notably in Asia. That's where the bulk of the buying is. And then, at least in the West, you don't seem to have a lot of selling. Retail numbers are improving in the US. So, for example, with Costco introducing gold, there are more access points for it. So, some of the bullion dealer numbers seem to be decent. So it is fairly broad, but it is more sovereign and more Eastern focused. And I guess one of the things that's remarkable about it is that the price is doing pretty well, despite the fact that nominal interest rates and even real interest rates are fairly high, which is normally a pretty significant headwind. Also, the dollar index is strong, and so the fact that gold is doing this well despite headwinds, I think has a lot of information in it.
So there's a lot to unpack there. Everything from Costco to central banks, and I hope we can cover as much as possible. But let's start with the central banks that you just mentioned there. So 2022, that was a record year, and 2023 there was also that was the second consecutive years where central banks bought more than 1,000 tons. And so, what's 1,000 tons of gold? How can we put that in relation to anything? So this is compared to an estimated 2,500 to 3,000 tons of gold being mined annually. We also have a gold stock around 200,000, perhaps a bit more, that's ever been mined. Now, let's start with if we look at the aggregated central bank balance sheets, how much of that is allocated to gold, and how do you expect that to change over the next 5 to 10 years?
So they have an amount that's like 30 some thousand tons, all central banks combined. And the history of that is that, during the 80s, 90s, 2000s, that overall tonnage was generally on a gradual decline in the world. And it bottomed in 2009, and then started gradually going back up from there. Is kind of the history of central bank gold holdings in absolute tonnage. We're also seeing that back around 2013, 2014 is about a decade ago now. Foreign central banks in aggregate kind of stopped loading up on US treasuries. And there's a number of reasons for that. Generally speaking, whenever the dollar index is strong, somewhat intuitively, central banks are not really buying treasuries much when the dollar index is strong, and that happened around 2014. And so, we've kind of been in this like stronger dollar environment to varying degrees since then, and there's been less treasury buying, and largely because of it. There's a couple different reasons. One is that about a decade ago, China announced that accumulating treasuries is no longer in their interest, and so we've seen a shift from them toward diversifying of their portfolio strategy and including more illiquid investments, things like lending to other markets for commodity deposits and infrastructure, basically the Belt and Road Initiative type of activities. That's kind of been one of the areas, as well as increasing their gold holdings. And so there's been some strategic aspect to it, but there's also just the strong dollar aspect, which is that whenever the dollar is in one of its big weakening cycles, like it was in the 70s or like it was in the late 80s or like it was in the 2000s, generally, other currencies are therefore doing pretty good. and sometimes they even want to weaken their currency a little bit. And one thing they can do is increase their reserves. They can create more of their currency and buy foreign assets. It could be treasuries, could be gold, whatever. So generally, they tend to accumulate assets, including treasuries, on a weaker dollar trend. But when the dollar is strengthening or it's kind of holding at a strong level, they're generally more in currency defense mode. And so they're usually not increasing their reserves by very much. Now that's as a group. You could still have individual countries that are acting out of the average. But as a group, their debts, their like dollar debts are generally harder because the dollar is stronger now. Their currencies are a little bit under pressure. And so they're, if anything, they might be selling some reserves to buy back their own currency, but at the very least, they're often just not really accumulating reserves aggressively when they're trying to keep their currency propped up to a significant degree. That's the environment we've been in. And so, but around the margins, they are pointing more toward gold than treasuries over the past 10 years or so. And I think there's a number of reasons for it. I mean, basically, during the entire kind of post GFC decade, treasury, short-term rates were held at near zero. You also had this increasing kind of, I would argue, a multipolar tendency in the world. So any sort of U.S. security, treasury security, stock security, corporate bond security, whatever the case may be, those are freezable assets. They can be unilaterally frozen by the U.S. government. And so there's a number of entities that are either frenemies or competitors or just for their own, even if they don't see like as a high possibility that their reserves be frozen, they say, look, I mean, we might be pressured at some time in the future. We don't know who's going to be president 4 election cycles from now. So let's diversify into a little bit of other currencies. Let's diversify into gold. These are kind of the options that they have available to them. And I think those are some of the trends that we're seeing in that kind of central bank world.
Would you know? I know I'm putting you a bit on the spot here, Lim, but would you know percentage? Like, is it? Are we talking about 5% of central banks' balance sheets that's allocated to gold? Is it 10%? Where are
Last
we
I checked,
roughly?
it's over 10%. I don't have the numbers in front of me. And it depends on the central bank. I mean, Russia, for example, even before their reserve freezing, they had a very high percentage of gold. Um, Canada's like got, I think they have like no gold anymore. A lot of the European ones are fairly high. Italy, Germany, they have a fairly high gold percentage. The United States, because they're the axiom of the current system, they have very minimal foreign currency reserves, but their gold holdings are still substantial. And so in aggregate, I believe it's low double-digit percentage, which makes it one of the larger reserve holdings, but still notably smaller than their collective treasury holdings.
Yeah, and just to continue that, whenever you say reserves, like you're referring to treasuries because there are interest bearing. It's not like the actual currency, but you're talking about treasuries, and that can be frozen. Is that correct?
Yeah, I'm referring to foreign exchange reserves. That's different than bank reserves. So yeah, it's good to bring up that distinction. Bank reserves in any given country are part of their base money, along with currency in circulation. That's a direct liability of their central bank. Um, Whereas foreign exchange reserves is, a country is operating, basically there's 160 currencies in the world. And you can kind of think of them like arcade tokens, where they're all these kind of, some of them are pegged, some of them are free floating. Um, and when more capital is kind of flowing into that currency, it's generally strengthening. And when more capital is leaving that currency, it's generally weakening. And that's also partially dependent on the supply and demand of that currency, right? If Argentina's currency is expanding at a very rapid rate. Not a lot of people want it. And also the supply keeps increasing. So that's going to keep deteriorating, diluting against other currencies, for example. That's a fairly extreme case. But in a more marginal case, generally speaking, or if a currency is weakening too much, they want to be able to have something that they can sell and then buy back some of their own currency with. Basically, all these currencies are being bought and sold. Many of them, so something like 90% of FX transactions, and FX is a massive market. Something like 90% of them have the dollar on one side of the transaction. And so there's not a lot of volume between different currency pairs. They're mostly like if you want to go from one currency to another currency, it's often your currency to the dollar and then the dollar to that other currency. That is changing a little bit because, say China and Russia are doing more direct swaps now and things like that. But in general, that's still the case globally. And so, a lot of, and also, for example, most international contracts are denominated in dollars. Most global capital, like if an investment company in Germany lends to a corporation in Brazil, for example, even though the dollar is neither of their currencies, that's likely going to be in dollars. The euro is the second biggest, but it's a distant second. So the dollar is by far the biggest currency used for international lending. So denomination of international contracts, denomination of international lending, and most for oil sales, that'd be part of international contracts. And so the purpose of having reserves is a fewfold. One is that they can defend their own currency. They can sell some of their reserves to buy back some of their own currency, or inversely, if they want to weaken their currency, they can create more currency and use it to accumulate reserves. That's one tool. A second one is that if they have various entities in their country, for example, corporations or banks that are doing dollar financing in one way, they might have dollar debt. This is particularly true for emerging markets. The central bank wants an option to be able to bail those out if they have a crisis. So they want to be able to lend dollars to those corporations, so that they don't just nominally default every time there's a recession. And so they kind of maintain stockpiles of that. And of course, central bank um, swap lines can increase that flexibility, but they don't want to have to rely on those necessarily because they might not be given them by the Federal Reserve. And so they often hold a number of quote unquote kind of hard monies. Um, and the dollar is considered hard just because, for example, if Brazil's holding dollars, they can't print dollars. From their perspective, that's a hard asset. And from the international perspective, even though it is diluting over time. But because that's what, a lot of their contracts are denominated in, their debt denominated in, that's a big tool for them. And gold is something that is, over time it holds up well versus dollars and treasuries, but it can have a decade where it, underperforms. And then also it is volatile compared to the unit of account of those liabilities and those international contracts. And so from that perspective, it's maybe a little bit less useful as a reserve asset in this existing kind of international system. But it still works as a significant percentage because, the volatility is not huge. And on average, over time, the value holds up well compared to dollars.
So if we go back to the central bank's aggregated balance sheets, and like you mentioned, 2009, there was, you know, bottom in recent times. So it was around 30,000 tons at the time. Now we might be looking at something more than 36,000. And so what am I comparing that to? Am I comparing that to the M2 money supply? Whenever I'm looking at an increase from 30,000 to say 36,000, it sounds like a lot. So it's 20%. But what else has grown 20%? Is it even so that you can say that the aggregated gold as a percentage of the balance sheets are smaller than it's been a long time?
Yeah, so in general, because you've been in a strong dollar environment for the past 10 years, there's not been a lot of net reserve accumulation, even though there still has been money supply growth, broad money supply growth. And so on average, the level of reserves has been decreasing relative to M2 for a lot of countries because most of them are more in currency defense mode than reserve accumulation mode. Now, if we get a big dollar down cycle, you could see a big multi-year period of reserve accumulation. But that's not the environment we've been in. And so, yeah, a lot of them are going down in terms of reserves compared to broad money supply. There's a couple ways to look at it. You can look at it as a percentage of their GDP. You can look at it as a percentage of their broad money supply. You can look at it as a percentage of their external debt. So, for example, if a country in aggregate has, $100 billion worth of external debt to either its sovereign or its corporation denominated in currencies they can't print, you might want to then compare their reserves to see, how if they had to, how much of their reserves would they have to sell to cover most of their debts. So that's another metric to look at. So it depends on what exactly they want to do with their reserves. That's it. Those are all useful metrics to be familiar with, because a less indebted country might need fewer reserves. Also, in general, developed countries tend to have less reserves relative to their GDP than emerging markets because developed countries tend to have most or all of their liabilities financed in their own currency, and so they're less likely to, you know, kinda need to support their own banks with foreign currency, for example, compared to emerging markets where that's a bigger deal. So, reserve practices will vary, and it's not always like that higher is better. I mean, basically, if a country is having a current account surplus and a trade surplus and its currency is strengthening, that would otherwise go toward, you know, wage earners in that country. That would go toward savers of, you know, those currencies in those countries. And instead, when a country is accumulating reserves, it's making sure that its currency is not getting stronger, which actually takes away from the wage earners. It takes away from the savers. But of course, you know, down the line, they could use it to defend the currency should it weaken. But in general, a country that's always accumulating reserves is generally running a rather mercantilist policy, which is that it's trying to keep its wages and its kind of citizenry not super wealthy, so that they remain very kind of competitive on the global scale in terms of labor costs. And instead, a lot of that capital's flowing up to the top, the policymakers, who then have more control over it, rather than kind of letting that flow into the country in a more decentralized way, kind of flow more toward those individual entities.
So if we look at the data from the World Gold Council, which is an excellent resource, I should say, if you want to learn more about the gold market. So China is currently the biggest central bank buyer of gold, and if you look at the list, and they have monthly updates, and then they also do some aggregates. But you also have countries like Poland, Turkey, Singapore. They've recently bought up heavily. But whenever you look at the list, you don't see a lot of Western Europe or say the States. Why is that?
So I think partially because they're closer to the center of the current system, and so they have less incentive to change the current system. Many cases, they're not increasing their reserves at all because, again, most Western countries, their liabilities are denominated in their own currencies. So most European entities, their liabilities are in euro. You know, North American companies, their liabilities are denominated in dollars. Same thing for Australia. Same thing, you know, Japan's not exactly in the West, but it's kind of Western aligned. Same thing's true for them. Most of their liabilities are in yen. If anything, yen is actually the third biggest foreign currency financier after the dollar and the euro. Um, and so they just have general less need of reserves, period. And then, you know, Europe, for example, and the United States, they already have a lot of those countries already have fairly large gold reserves as a percentage of their reserves. And so we just don't really see a lot of, you know, reserve accumulation. A lot of them are not running big current account surpluses that would lead them to have a lot of ammo to accumulate reserves. Um, and so a lot of that reserve accumulation would probably have to come out of other holdings. They'd have to like sell treasuries and buy gold, which is somewhat of a political message. Um, and so, yeah, there's kind of not been a lot. The incentives don't really align currently for a Western country to kind of step out of the pack and just start rapidly accumulating reserves, let alone gold reserves specifically.
So let's say that you're not one of those countries, and you have a central bank, and like all central banks, they can print money. And then say that you're also a country with a very unstable currency, and you would benefit from having more gold on your balance sheet. Why would a central bank not print a very significant amount of whatever local currency that would be and just buy gold?
So because it risks inflation and devaluing the currency, basically, you mentioned, for example, an unstable currency. If they already have an unstable currency, then they're in a difficult position of accumulating reserves because they ironically might have to make their currency even less stable while they're accumulating reserves. If they're printing a lot of their currency to buy gold, it means more of the supply of their currency is hitting the market. And so, you know, if they're already dealing with double digit CPI, for example, and there's popular unrest because of that, civil unrest, um, last thing they want to do is maybe add another 10% to currency supply and increase their gold by a lot. So some of them do it despite high inflation. They might do it in fairly small amounts. So they're saying, look, we got to think longer term. I know inflation's high, but we still want to increase our gold reserves. They might do it anyway. But in general, reserve accumulation tends to happen more from a position of strength. A country's running a big trade surplus, current account surplus, their currency's holding up well compared to the dollar. And then they say, look, now we're gonna use this opportunity to keep our currency from strengthening. So we don't like kind of, make our labor too expensive as far as they see it. And we're gonna use that context to accumulate reserves. Whereas usually when they have currency instability, if anything, they might be selling reserves or they might be trying to hold reserves steady, because they're trying to reduce the instability of their currency in the moment. It's hard to think 10 years in the future when you're worried about, the public unrest about inflation this year.
So, perhaps looking away from Zimbabwe, which is a we can probably do an entire series just just about Zimbabwe. But why wouldn't you have, let's say, a country like Argentina, and then who has a triple-digit inflation number, and then they talked about dollarization. Why not go crazy with the printing press? Some people might say they already done that, but why wouldn't they go crazy then? Buy a ton of gold, and then dollarize or have it their own currency backed by gold.
Well, so once if you do it very rapidly, the race is on. I mean, your currency is going to start collapsing, and you're gonna get your reserves. You're probably not gonna make friends in the international community, like in the IMF. So there's kind of a sort of a hierarchy there, or there's a club there. And if countries find themselves kind of out of the club, things are going to be rougher and different for them going forward. And so there are kind of certain international frameworks. Also, countries can be labeled as part of this club. They can be labeled currency manipulators. If a country is purposely keeping its currency very cheap and is rapidly accumulating reserves to keep its currency cheap, um, the United States or other countries might call them out. And then that could have political implications. It could have IMF implications, things like that. So there are kind of these dissuading methods, to kind of represent like, kind of, diminish these more outlier type of activities, at least as a large percentage of their GDP or large percentage of their M2, um, from happening kind of at a quick basis.
Where would central banks buy, let's say, 100 tons of gold? Would they go directly to the producers? Would they buy from other central banks? Would they buy quote unquote in the market? And then what is the market whenever you're looking at those type of quantities? It's not like they would go down to the local dealer like the rest of us. So how does the system work?
So there are people that are more tapped into the plumbing of the gold system than me, but in general, a lot of these really large buyers, like sovereign buyers, a lot of them are going to do like over the OTC purchases. So you're not going to a defined exchange. They're making a more kind of peer-to-peer private agreement to accumulate it. For many of these countries, they'll buy it from their internal producers. So for example, Russia, China, Turkey, they have decent gold production. So you'll generally see purchases from them. They also can buy from international producers. They can buy from international large refiners, that are capable of kind of brokering pretty big contracts for these things. And then, yeah, there also are exchanges, for example, London, notably, where fairly large amounts of gold could be purchased. So it really kind of depends on whether they have internal production and what size they're buying in, but yeah, a lot of that's gonna be off exchanges.
So the question then remains. Let's say, and I'm going to put on my tinfoil hat, at least to some of our listeners. Whenever I say, what if we had a gold standard? What if we, for whatever reason, uh, needed a reset of the system and we went back on a gold standard? Who would proportionally benefit the most compared to the system that we have today?
Well, so generally, people holding gold would benefit. That'd be kind of the biggest, beneficiary. Um, most countries don't have an incentive to do that right now. So most countries, if you kind of poll political leaders, most of them would not find it in their favor to do that. Um, It's also important to kind of talk about a couple different types of gold standards. So a true gold standard is generally like where you know the retail people using banks and stuff could redeem their currency for gold. So you have a lot of points of conversion to reinforce that gold peg, right? In over time, as when you kind of saw the transition from gold standard to fiat standard, they generally their gold holdings as a percentage of their monetary base or as a percentage of their M2 kept decreasing. So they would start to add more frictions for that redemption process. They say, look, you can redeem it, but only if you're going to do $1 million or more, right? Or they say you can redeem it, but only if you're a foreign central banks or actually our own citizens, not really on a gold standard, but we're going to maintain this peg with international markets to kind of maintain the validity of this peg. There's kind of like different levels that it can go toward. One of the challenges, and I pointed this out in Broken Money, is that when you have a multi-layered banking system, so when you have a central banking system, like you have banks built on a central bank built on gold, the problem is that individual banks don't have any tether to that gold. So they're required to maintain a certain percentage of their reserves. I mean, of their assets and reserves, for example. Um, they're they're required to maintain certain capital ratios, which could include reserves. Um, but they can lend quite liberally, and when they lend, they create more M2 money supply. And the central bank is also fraction reserved. So they might have, back in the old day, they might have 40% of their monetary base backed by gold. So you have M2, which it might be 5 to 1 or 10 to 1 compared to the monetary base. And then the monetary base might only be 40% gold, for example, or less if they're running into a problem. And so there's multiple entities that when they lend, they're not even thinking about how much gold the sovereign's holding. It's just not their concern. And so you generally see an expansion of the money supply. There's no real kind of method to contain the money supply relative to the amount of gold when you have that multi-tiered system. And so, I mean, I would argue that's why they all broke, is that they kind of shifted from, back in a free banking environment where each individual bank has gold, or gold, assets that could be liquefied into gold. They're making loans. They're trying to monitor their own reserves. But when you have that multi-tiered system, everyone's kind of removed from the problem. And so money supply tends to grow and proliferate, whereas gold reserves don't. So I think that if they were to try a gold standard, it'd be a big reset. But then over decades, you probably would break all those pegs again because there's no firm tether between the amount of gold and overall loan creation. Notably, in the United States, there is for example, if you look at the Fed's operating handbook, they have a mechanism for gold revaluation. It's actually initiated by the Treasury, not the Fed, but it involves operations between the Treasury and the Fed. And I mean, they could do a reset that doesn't involve going back on a gold standard. They can just they can increase the official dollar price of gold. And that's a mechanism where they would be able to get more money in their Treasury general accounts without associated increases in debt, and therefore they could spend that into the economy without debt issuance. And so they could technically do a big, say, dollar devaluation relative to gold, and kind of reset a lot of debts. That's kind of one of the kind of the debt jubilee mechanisms that they technically have. Although it'd be a huge political lever to pull should they do it, but it's actually there in their handbook. And again, it's different than going back on an actual gold standard, which would be that currencies are redeemable for gold.
And how would that uh work? If they would do that revaluation? Would it be them basically saying now gold is worth, I don't know, $25,000 an ounce, and then that will be a new standard without going on the gold standard? Could you paint a bit more color around what that change would look like for the states, but also for the entire system?
Right. So back like something like 90 years ago, um, so it used to be that the Fed held gold and the Treasury said, look, we're going to hold the gold now. Um, and instead, so the Fed had to give their gold to the Treasury. And in exchange, the Treasury gave the Fed gold certificates as an asset. It's most an accounting gimmick so that they don't have a hole in their balance sheet. But basically, they were non-redeemable gold certificates. So they're kind of saying, look, these don't really mean anything, but they're technically representing your ownership of gold held at the Treasury. And what the mechanism can work, and that was at the official price at the time. And that price is, like $42 now. It was revalued once, but it's $42 now. It's way below the actual market price of gold. Um, So what they could do, for example, is say, well, now the official price of gold is the market price, or you technically could go above the market price. And if that happens, the value of the Fed's gold certificates increase in dollar terms. So that's an asset for them. And they provide an associated liability for them in dollars in the Treasury's general account, which is an asset for them and a liability for the Fed. That's basically the government's checking account. And then what that allows them to do is they can then spend money into the economy that they did not issue bonds for because instead they got that through gold revaluation. And that would generally be fairly inflationary. It probably would increase the price of gold if they were to do that. Um, and so that's kind of the mechanism. They can also, I mean, they technically have the kind of like how they can do open market operations with treasuries or mortgage-backed securities. They can do open market operations with gold. They can start creating reserves to buy gold. And so and of course that would generally decrease the value of the dollar, increase the value of gold. And so they have these kind of mechanisms that these levers they can pull that would say sharply devalue the dollar-based debts relative to gold, which means the reserves of central banks increase generally relative to their country's liabilities, which are denominated in dollars. It generally means that you get more inflation, more money supply growth in the US, and therefore various debtors would be partially relieved relative to their price of their nominal assets going up.
Thank you for painting some color around that. Then it was very interesting to hear. And let's let's transition into talking about gold as a way of allocating some of your capital in your portfolio. I mean, Riddell just famously had this 7.5% gold allocation in this all-weather portfolio he talks about in his books. And he has talked about holy grail of investing, 15 uncorrelated bets. But I'm curious to hear your take on this. Uh, which place does gold have in your portfolio, and why?
So mostly in inflationary or stagflationary contexts. And there's a lot of nuance there. So basically, there's been four major inflationary decades in the Western world, in let's call it the modern era, the oil era, for example. So the 1910s, the 1940s, the 1970s, and then to a lesser extent the 2000s. These were big energy bull markets. They were elevated inflation compared to the decade before them, and generally just elevated inflation in general. Um, and so you generally had things like oil doing very well, commodities in general doing very well, gold and silver doing very well. And normally stocks and bonds as a group did not do particularly well in all four of those decades, especially in real terms, but generally even in nominal terms. So, for example, the bull market of stocks in the 2000s failed to kind of break out from the dot-com bubble highs, um, even like, 10 years later, for example. Um, the markets in the 70s, the markets in the 40s, the markets in the 10s, 1910s, they were all weak in terms of stock market performance. Um, and bonds also obviously did pretty poorly as well in those inflationary environments, especially if they entered them with fairly low yields, which was usually the case. And so during those decades where both stocks and bonds do poorly, the 60/40 portfolio is not very good. And instead, having some of those exposures to those commodity, energy, hard money assets historically would have been the diversifier you need in that decade if you wanted to have this kind of like passive rebalancing portfolio that is all weather. That's where those types of assets come in. For the commodity portion, commodities in general are not good performers. They tend to have, like, 2 bad decades and then 1 good decade and then 2 bad decades and 1 good decade, but that good decade tends to be the one where stocks and bonds have a bad decade. Um, and so it's a useful diversifier in that sense, and among commodities, gold has been one of the best performers, and also, energy producers have been good performers. Those are kinda methods to diversify a portfolio, and the inflation thing's tricky because, if inflation starts to get hot, but then the market says, well, the central bank's going to get very hawkish then, and they're going to quell the inflation. Then in that particular year, gold might not rise. the higher real rates might deter people from buying gold because they're confident that, look, I know CPI is high, but the central bank's on the case. Instead, where gold tends to go up is when money supply is increasing and inflation's building, but the central bank hasn't really acted yet, or they've tried to act and they've not really been able to contain it. Those are the scenarios where gold tends to do well in inflationary times. Gold can also do well in disinflationary times if you have a rapid fall in real rates. So, for example, in 2019, gold had a good year. Uh, Official kind of real rates in the U.S. went from positive to negative. We had an economic slowdown. Stocks were kind of chopping along, and gold did fairly well. It was a useful diversifier in that environment. So there's a number of different contexts where gold does well, but the really big picture view is that gold and similar assets tend to do well in decades where neither stocks or bonds do, which is, you know, s- basically the commodity capex cycle has run its course. There's more scarcity. There's maybe more money printing happening, various kind of inflationary reasons, and that's where gold tends to be a useful diversifier.
How do you get started with stock investing? I've put together a course to teach you everything I wish I knew when I first started investing in stocks. Let's start at the beginning and ask, what is a stock? Let's zoom on in into what it's actually like to buy a stock. A few options are Charles Schwab, TD Ameritrade, Ally, E-Trade. Fortunately, you won't have to necessarily calculate all of these taxes yourself. I'll outline a few main ones to be aware of throughout your lifetime investing journey. As Warren Buffett says, your best investment is yourself. There's nothing that compares to it. By the end, you'll be savvier about stock investing and personal finance than the vast majority of people. Even if you're not a total beginner, I'm confident you'll get a lot out of the principles and strategies I outline, which we'll build on throughout. A link to the course is available in the description below. See you there.
So so far we talked about gold as I'm gonna say a concept here, and I don't know what the listener are thinking right now, if they're thinking an actual gold bar or how they picture it. So let's actually have a conversation about that. Whenever some people talk about something called paper gold, and then and some people refer to like taking possession of actual physical gold. How do you think about that for your own portfolio? And perhaps we can start with what is paper gold in the first place.
Right, and there's a couple different types of paper gold. I mean, a basic one would be any sort of future, or other derivative, where, one entity is agreeing to be able to buy gold at a future date, but then the vast majority of the contracts are cash settled. So a lot of people are placing bets on gold in that environment, but then few of them are ever taking delivery of the gold. And in that context, you can have a lot more claims. So you can have a lot of the people that are like making those features to like sell gold might not even have the gold. They're just knowing that, look, I mean, if gold goes up 20%, and we'll cash settle this and I'll have the dollars to kind of settle that. Um, but if you get a major spike in gold, some of these counterparties might not be able to make good on the actual delivery of gold should it be requested, or the dollar price if it kind of breaks and goes nonlinear. And that's happened on other commodities. For example, the London Metal Exchange had to kind of step in and do controversial actions because of that. Where just there's like a short squeeze and entities just really don't have what's owed. And so paper gold is basically claims for gold that are not necessarily backed by gold. Another thing that could happen is that some ETFs, for example, might hold unallocated gold, which means they're holding in a custodian that says, "Look, you don't have specific bars, but yes, you're entitled to this much gold." But then that custodian could potentially lend that gold out to someone else, and so again, they're in a situation where there's more entities that have a claim on gold than the amount of gold that is underlying. And that, in different eras, that ratio of kind of paper gold to physical gold can vary. It can be hard to measure. Some of that market will be opaque. Then there's a spectrum of how secure your gold is. If you're using kind of one of the ones that's using unallocated gold or derivatives at scale, that might be one of the ones that's a little bit more um, less certain if you get a really big gold spike, whereas other ones might hold, for example, fully allocated gold. They might even be redeemable. Some ETFs are actually redeemable for gold if you're doing it at scale. Um, and then physical gold in your own possession, what makes that interesting is it's a bearer asset. So most of our investments are permissioned. We have an account at a brokerage. It could be frozen, it could be hacked, it could be confiscated. I mean, in the US and Europe in modern times, these are generally not concerns we think about, but in a lot of countries, these are concerns to think about. Um, and so all of your assets are held on your behalf by counterparties, which the government could just tell them to do something, or the counterpart itself could have a problem. And so there are certain assets like physical cash that you can hold, but of course that you get diluted over time. And so there are assets like physical gold in your possession or, cold storage Bitcoin in your possession, these types of assets where you have unilateral control over that asset with no direct counterparty between you and the asset. And having that appeals to some people. It basically they say, look, I mean, if I wake up and like my accounts hacked or the government did some sort of memorandum and just kind of froze all brokerage accounts in my country and said you can't own this assets or you're being forced to sell this asset and buy this other asset because we have a national currency crisis or something. um, they hold that asset outside of that system in their own possession. It's outside money. Collectibles are also in that category, but they're less liquid than things like gold or Bitcoin, and so that appeals to some people. So it really depends on what exactly you're trying to protect from. If you're mainly trying to benefit from the fiat price of the asset, then things like ETFs could be useful in a portfolio, and you can always decide, you could pay a little higher fee for one that's kind of fully allocated, for example. Um, or if you wanna actually have kind of the full outside money experience where you have assets that are either in your possession or maybe you add a custodian that's not a bank, for example, or you could diversify them internationally. You can have international custodians hold some of your assets, which, again, sounds kind of like tinfoil hat if you're in the US or Europe in the modern times, but is less tinfoil hat when you look around at the 200 plus countries that are out there. But then even in those countries, I mean, in the past, when we have wars or when we have kind of big issues happening, like the United States, gold was banned for like 4 decades. It was you could go to jail for holding a benign yellow metal. Um, and but ironically, a lot of people held it anyway. The market became very illiquid in black market for a long time, but there are people that just held for that through the entire 4 decades because it's a very hard thing to enforce. It's very expensive to go door to door and get people's gold or other kind of bear assets. And so it kind of imposes a cost for enforcement compared to if everybody has their assets in a brokerage account, one stroke of a pen can just, force everyone to sell this asset, buy this asset, or freeze this asset, give them the current price for it, and take it. Even if there's some sort of nonlinear price action that maybe happens after the fact. Um, that's where the physical comes in handy for some people.
Yeah, I think it's at the 1933 executive order that you can hold 5 ounces of gold. If you held more, you could give up to it was a $10,000 fee and 10 years in prison.
Yeah.
But it was also it was a different time, obviously, but it was different in the sense that it was also very much framed like you're doing a service to your country, and so I whenever you read gold books, and I'm gonna come up with this terrible assumption that people read gold books, but the 1933 executive order, and it is always one of the chapters, and then Nixon taking it off in 1971, and then Ford sort of like making that legal again. I want to say 1974, but it's always one of those things where you think, can this happen again? And again, we don't know. I would say that it's such a different world today. Also to your point, Blaine, it's very difficult to enforce. And I would probably say that it would the way it was framed at the time about I think it would be and this was also between two world wars. I think it would be very difficult to do the same thing again and have people comply with those um, rules. And perhaps it's just me who are saying that we're not going to see gold confiscation again. Who knows? There's this old saying that gold doesn't matter until it matters, and that's whenever you can't get access to it. So who knows?
I generally agree. I mean, back then, gold was part of the monetary base, and it was a bigger market relative to other assets. And that was generally an era of capital controls. And so capital generally wanted to flee from weaker areas to stronger areas. And, the US was in the position where they were one of the strongest areas the capital wanted to flow to. And so they didn't really have to worry about like their capital flowing to other countries. But they did have to worry about their capital flowing to gold, which is like the one thing stronger than the US system. And so they basically said, look, gold gold was outperforming their bonds, and they needed people to own the bonds that were losing purchasing power. And so that was a method they turned to. Now, to your point, that was like a we're all in this together, service your country mindset. Um, Back then, I mean, under FDR, for example, there was a super majority in Congress. One party controlled kind of all the super majority levers of power, and the country, like as a group, was very kind of unified around an external threat. The environment is very different today. It's hard to pass big, sweeping, draconian things like that. You tend to see it more in emerging markets. I mean, there are some countries where it's legal to own dollars, because people are turning to dollars to try to protect them, like literally physical dollars. Um, uh, or it could be illegal to, maybe it's not illegal. Sometimes it's legal to outright own them. Sometimes it's instead they'll crack down on the brokers that are making those dollars available to people. So they kind of try to reduce liquidity in the market. Same thing can happen with gold. In a lot of countries now, including the US and much of Europe, there are laws around if a gold dealer sells you gold in any sort of meaningful scale, maybe 2,000 euros, maybe $10,000, depends on the jurisdiction. They have to then report that to the government. So if you buy $20,000 of wine, they don't have to report that. But if you buy a fairly small amount of gold, they have to report that because that's a liquid monetary asset that they want to try to track. Um, and so there are kind of around the margins pressures against liquidity in these markets, and trying to surveil these markets. But I would agree with you that, wholesale confiscation or illegality of gold is unlikely, in most countries today.
Yeah, one of the wonderful things about speaking with you, Lynn, and I should say that there are so many. We had some interesting discussions about gold throughout the years, and in some of my research to one of the previous conversation we had, I called up a gold dealer and sort of like to figure it out because I heard about to your point before about the know your customer. And it's kind of crazy how much information they need on you if you want to buy gold. Also, one of the things, and I should say, I don't buy 400-ounce gold bars, but I couldn't help but ask because I was doing research anyway. So I was asking, so what happens? Like, what happens if I click buy to that 400-ounce gold bar? And he completely panicked, and he was like, he didn't know. Like, no one ever did that, had never done that before. And he was like, there was like a central bank thing, and he was like, I think they buy from the producers. But it is kind of like an interesting topic. Not because I'm by any means an expert, but like the plumbing into the gold system. It is like I find it very hard to find good information on, and and there are so many rumors. We briefly talked about China before, and they have like the two biggest producers in the world. That's Russia and China, who are notorious for not providing a lot of information. Um, I would be curious to hear you, Lynn. How much do you? That's gonna sound too much like a biased question, but uh, you have public numbers out there of Russia's and China's gold holdings. How much do you think that they are understated? I think that there's generally a consensus they are understated, so that's why I'm giving you that biased question. But I'm still curious to hear your thoughts on that and how you came up with that information.
Well, so I have different thoughts on Russia and China. Russia reports gold reserves that are fairly large relative to their money supply, relative to their GDP, relative to their external debts. and that this was even before, um, the invasion. That this was something that they had already kind of been de-dollarizing and focusing on gold. Um, so I assume their numbers are probably fairly accurate. It's Chinese numbers are more interesting because they have, it's a pretty large amount in absolute terms, but it's a small amount relative to the size of their economy and their amount of total reserves. And yet they're in a position where you'd think that they'd want large amounts of gold because they'd be worried about Western sanctions. We don't know what's gonna happen with Taiwan down the line. They wanna be able to, transact outside of the dollar-based system. If the US sanctions some entity like Iran, for example, China wants to be able to just transact with them anyway. Um, and so they have a lot of reasons to operate outside the dollar system, to hold reserves that can't be frozen, and things like that. Um, a lot of estimates, when people kind of trace where gold is flowing, like it's going to refiners and then where is it going afterward, a lot of the numbers show that massive amounts of gold have moved from west to east, and particularly to China. And so a lot of those estimates show there's something like 20,000 tons of gold in some, call it 20-year period, have flown, has moved over to China. Now, I think the big question is how much of that is officially or, um, either in government hands and not being reported, or it's maybe close to government hands, like, they might be spreading it out, and they say, "Well, this chunk's in the military, this chunk's in this chunk is in this kinda local government." That technically, like, maybe the central government knows where they are and could absorb those if, quote, unquote, "needed," versus how much of that is in fully private hands. A lot of the big Chinese banks, if you're a retail customer, they will just let you buy gold from the bank. It's kinda how it used to work in the West. And so gold is one of the, like, approved assets in China. There's large, private sector ownership of it. And so what's pretty clear is that there's a very large amount of gold in China, and what at least from my perspective, what's hard to know is how much of that is in control of or easily identifiable to the government. I would probably say it's over the number they report by some meaningful margin, but I wouldn't go as far as to say, like, all those 20,000 tons are in their hands because I think some significant percentage of that went to various private sector entities.
Yeah, and I think you bring up a good point, especially considering the capital controls of in China. It's a very popular type of investment for the Chinese. Um, and I'll just one quick story. I don't know if anyone has this fascination with gold, but I remember growing up and watching all these movies, and then you had these gold bars, and I would say that because gold is so heavy, um, they're actually very, very small. So whenever we talk about 400 ounces or 12.5 kilos, like it's remarkably small. And I'm not gonna pretend like I'm buying gold in that quantity. I did have a chance in Perth whenever I was traveling one time to go into whatever kind of place, and there was like a gazillion cameras around me, and then you could like put on a glove and put it into like a mantra, and then someone would make sure that you didn't run away with it, and you really, really couldn't. And it's crazy. Like it's such a small bar. It's like so heavy, and so and that has been how we traditionally have been looking at gold. Now today, um at least if you read the the gold magazines, and because of this increased interest of gold, specifically in Asia, like the standard has gone to 1 kilo bars away from the traditional 12.5 kilos, which is 400 ounces. And so, and we're talking about like $1 million is for like one of those bars, the bigger one. So it's significant amount of money. And if I can use that as a segue into talking about Costco. And Costco is known for being a place to buy cheap quality goods. And I have to say I didn't expect to see gold on the Costco shelves. And so they had recently famously have these 1 ounce gold bars. So at a cheaper price, of course. And I would also say at a good price. And what do I mean whenever I say a good price? Well, when you look up the gold price, say online, you get this so-called spot price, but that's not the price that you're paying at Costco or whatnot. So, Lynn, could we um, be practical here and say, if you want to buy gold, uh, how much are you supposed to pay above the spot price? Why are you paying above the spot price in the first place? And how does that relate to like whether you buy an ounce, a kilo, and yeah. So I guess I'm throwing all of those questions over to you right now.
Well, yeah, it's a good set of questions. The premium you pay over spot will vary based on the situation. For example, people that were trying to buy during the pandemic when refiners were closed and people worried about the world ending or the financial system imploding, um, that the premiums got very large in that environment. It's kinda like buying insurance after you need insurance. If you buy it in normal market environments, it's gonna depend on what type of gold you're buying. Costco is probably gonna come in near the best, I assume, because they can do things at scale and they can lose money on some items and make money elsewhere. But, at a normal places, generally speaking, if you buy something like a 1-ounce gold coin, even if you buy, like, 10 of them, you're probably gonna pay something like 3 to 5% above spot. Whereas if you buy a larger bar, you might be paying 1 to 2% above spot. And one way to think about that is there is a verification premium, which is to say that if you buy a very large bar, there's some non-zero chance that someone has put tungsten into the gold bar because tungsten is nearly identically dense to gold, and much less valuable. And so one of the common frauds is you put tungsten inside and a thinner layer of gold around it. Um, so it truly is gold on the surface. It's just not as much gold as you're being sold. And those can be fairly hard to identify. You need fairly sophisticated equipment. And the only way to know for absolute sure that it's gold entirely down to the core is to melt it. That's one of the reasons that they melt 400-ounce gold bars and turn them into kilos. It's kind of a verification method to say that this is actually fully gold. Um, when you buy kilo bars, you're probably going to get a little bit higher premium than the 400 ounce. When you buy 1-ounce gold coins, the advantage there is that there's quite a lot of surface area relative to mass. It's much harder to put a little tungsten disc inside of a gold coin than inside of a kilo bar or a 400-ounce bar, because the work is similar and yet the payoff is much less. So it's a much less economic, incentivized thing to do. So gold, the whole kind of invention of coinage, over nearly 3,000 years ago, is or at least in the gold and silver variety, is that it's a verification of how much is there. So you have kind of a surface, like a stamp on the surface. You might have ridges around the edges. It's showing that this gold has not been shaved. It's hard to counterfeit, and it's hard to cheat with. Um, and so 1-ounce gold coins are kind of a sweet spot because they'll be liquid, um, and the spot premium is not too high, but it still is pretty high at the end of the day. I mean, at over $2,000 an ounce, you could be paying $100 above spot price for your, gold coin. Um, and then, when you go down to, like, smaller coins, there's like 1/10 of an ounce or even 1 gram. If you look at the numbers, they get kinda silly. You might be paying 50% above the spot price. The advantage is that at that scale, there's virtually no way to get tungsten in there. But the expense you're paying relative to the gold is extraordinarily high. And so that's one of the challenges of gold in general, is that gold does have a verification and transport cost. If you get it shipped, at scale, you're generally gonna want insurance. If you buy it with a decent amount of surface area, intricate surface area relative to mass, you're gonna pay up compared to, if you buy it in these bigger forms. And so that's all a cost to the physical owner that wants that extra assurance, that gold is in their possession and that it's actually gold. But yeah, whenever you can find a dealer that's willing to kind of operate at scale and be a loss leader, you could get deals, but those are generally the types of percentages or numbers to be aware of.
Yeah, and I should also mention, I hope no one's going to ransack my home. I have somewhere in my home 1/10 of an ounce. And the reason why I say that is because it got lost. 1/10 of an ounce whenever it comes to gold is very, very small. And we had a gold sponsor on at some point in time, and they said something along the lines of, we're gonna give you like 1/10 of an ounce. And I was like, oh, ship it to me. So I got like this huge package which probably cost way more than 1/10 of an ounce in terms of shipping. And like it was sent with what kind of courier, and I got like 1/10 of an ounce into my home. And it's just so small. I've never been able to locate it ever since. And just one more. Whenever we do the math on, we talk about like 400 ounces and what that is in kilos. So one tricky thing that I don't know if anyone's sitting there with a calculator is like, oh, the math is a little off. Whenever you're talking about an ounce and you convert that to grams or kilos, it's not a quote unquote normal ounce. This is a troy ounce, which is different, which is just confusing for everyone. So a normal ounce is 28 grams and change. And a troy ounce is 31 grams and change. And so I just want to clarify that. Um, Lyn, I wanted to. There are so many moving parts here whenever we talk about gold and the price of gold, and so I was wondering if we could do this small exercise where we say the everything else equal, which is a fancy way of coming up with if this happens, what then happens, and of course in the world of economics, it's always tricky because so many things are happening at the same time. So perhaps if we can start with the spot price of gold and sort of like hold that constant, and then and we have that on one hand. Then on the other hand, we have CPI, but we also have the overall money supply, respectively. So, what's the relationship there?
So it depends on the country and it depends on the time period. For much of the past several decades, the biggest inverse correlation with gold has been real rates. So when real rates are positive, generally there's been incentive for people to own treasuries rather than gold. Right? So for example, if you can get paid 5% on treasuries while inflation is 3%, you're making a 2% spread, at least over official CPI. And gold, you get no yield, but it's a scarcer asset. Um, and so generally people will flock toward those treasuries. On the other hand, if inflation is at or above the treasury rate, you're saying I'm getting a negative real yield on this inflating asset. I might as well just hold something scarce that I earn no yield on, gold. Um, and so you generally see more capital flocking toward things like gold. And so the big kind of peaks of gold, like in 2011, for example, or in the early 1980s, or even kind of at the in 2020 after it had a big run up and then kind of went sideways for a while. Those kind of big peaks that it hit were kind of bottoms in real rates, and real rates either went up or at least stopped going down for a period of time, and then that therefore kind of the excitement of or the panic of getting into gold would decrease and start to reverse back into typical financial markets. So that has been a very big variable historically, especially when compared to the dollar in general. But when you look at gold price and other currencies, you'll see a similar dynamic where if a currency does not have an attractive real rate, generally speaking, there's a lot of incentive to flow out into either dollars or flow out into gold, depending on what the situation is. Um, in in recent years, there's actually been a pretty sharp divergence where real rates went up quite a bit because the Fed's trying to fight inflation, and normally, you would have seen a pretty significant decline in gold, but instead, gold held steady, and then even recently broke out to new all-time highs in dollar terms, despite the fact that real rates are fairly high. Now that you can assign a lot of different things to that. One is geopolitics, as we discussed. There might just be more incentive for central banks to buy gold despite real rates because they say, look, we're not caring about 2% real rates for the next 5 years. We're worried about our reserves getting frozen, right? So we're buying insurance. We want to be able to hold some of our own assets in a sovereign way. That's number one. Number two is that, I would say that the U.S. fiscal situation is fairly acute in the sense that, I described as being in fiscal dominance, which is to say that fiscal policy starts to constrain monetary policy options. Or another way of putting it is just the fiscal deficit relative to the size of private sector money creation. Um, and so annual fiscal deficits in the US are now larger than the sum of corporate bond issuance and new bank loans in a given year. Um, And so overall, as the Fed increases interest rates, um, it actually blows out the deficit even more because, it's not like the 1970s where we have 30% debt to GDP. We have like 120% debt to GDP. So if you raise rates super high or even moderately high, the interest expense starts to become huge. And so I think there's a number of entities kind of looking at this. And I've talked to, there's actually significant investment banks that will have like internal memos about fiscal dominance or fiscal problems in the US. There's a number of entities saying, "Look, I know real rates look positive now, but the math doesn't check out when you look 5, 10, 15 years in the future." It's just very hard for them to ever maintain positive real rates given their debt situation. And therefore, even though real rates seem high now, I'm gonna buy gold anyway, right? There's probably some of that happening as well. So we've actually seen a pretty significant change in correlations, where gold seems to be tracking things like the size of the deficit more so than just real rates. But yeah, there's multiple factors coming together. There's geopolitics, there's real rates, there's fiscal dominance, um, and a way to look at it is that on average in the US, money supply goes up about 7% per year, over the long run. That's in developed markets, you'll generally see that 6 to 9% rate. Emerging markets, it's usually double digits over the long term, percentage-wise per year. Refined gold increases in supply by about 1.5% per year, worldwide on average, according to credible estimates. It can vary between 1 and 2%. Um, and so, over the next 10 years, the Congressional Budget Office expects about 20 trillion in net new treasuries will be issued. Um, and so someone has to absorb all that. Whereas gold, at current production rates and prices, something like 2.5 trillion in new gold will be produced. And so there's kind of at least at current prices and production rates, there's a decent incentive to own the scarcer thing than the amount of treasuries that are going to be coming to market. And so I think there's a lot of variables here. Like you said, I mean, 5 years ago, if someone said, if real rates were here, what would you expect gold to be? I would have guessed a little lower than now. But this is kind of an end game scenario for a highly indebted government, which is to say that even when they raise rates, uh, the market doesn't really believe it. The market says, I'm going to own gold anyway because the math is no longer checking out for you.
So on that note, Lynn, I wanted to tell you about a survey I recently read from the World Gold Council, and they asked the country's central banks about what the reason was for them accumulating gold. And they at the very top of the list they had historical reasons, performance during crisis, all that good stuff. Then at the very very bottom, there was probably like 15 factors, whatever. It was de-dollarization. And so it made me think of a story. So the story is that there's a father and two small sons, and the father asked his sons to choose between a nickel and a dime. And the oldest son, he picks the dime, and the youngest the nickel. And then the father continues to play this game with the youngest son, and every time the youngest son he's gonna pick the nickel, and eventually the older son says to his younger brother, "Come on, like you must learn at some point in time, like a dime is worth more than a nickel." And the younger son says, "I've known that all along, but as soon as I tell father, he's gonna stop playing the game with me." So I'm gonna stop the interview on that note and give you a handoff, Lynn, and just say once again for the 10th time, like this book, Broken Money, is just absolutely amazing. So if you're interested in currencies, not just gold, but currencies in general, money, this is the book that you need to pick up. Where can the listeners learn more about Broken Money and you, Lynn?
So I appreciate that. Yeah, people can check out Broken Money on Amazon or wherever books are sold. And they can go to lynalden.com to see all my latest research, public and private, on markets, including gold, including other assets. And thanks for having me on.
Well, thank you for making time.
Here's an Egyptian pound. And this is, for all intents and purposes, a casino chip in the sense that outside of Egypt, there's almost nothing I can do with this. I can't buy goods or services with it almost anywhere. And even finding someone to convert it into local currency would be very hard in most places in the world. And even if I could, the fees and the exchange rate would be like awful. But what things like Bitcoin and stablecoins do is they go around those prior gateways.